Right, everyone, this is the second video that I've done linked to financial markets. What we did in the last video, we looked at the roles of the financial sector, so why it was so important for the economy. What I want to do in this one is to think about the different types of financial institution. Okay, so in other words, the different types of businesses and people that work in the financial sector. The one that you guys will be familiar with, maybe not by name, but by what they do, are retail banks. Because what retail banks are, they're aimed at households. Okay, so these are the banks that we will go to. These are your high street banks, if you like. Okay, now in effect, what happens is that when you think about the roles of a retail bank, it's somewhere where you deposit your savings. So into your bank account, basically. And what you can do that, you can use your bank account not only to save, but to pay in your wages or your incomes. And you can use it to pay for your direct debits as well. Okay, now linked to that, what we would also say that is that a retail bank through a bank account will give you the ability to borrow. So you've got those overdraft facilities. You might use it to take out mortgages or other types of loans. You might use it to access credit, so via a credit card. Okay, so you're going to use it to borrow in lots and lots of different ways. You might also use it to access insurance. So a lot of people will use their bank to provide them with house insurance, contents insurance, holiday insurance, animal insurance, all sorts of different things. The way that banks, or the retail banks, make profits, well, it's fairly straightforward, really. The savings that are deposited are used to provide loans. Okay, so when we borrow money, it's lent out by banks, and the interest rates on loans will be of a higher rate than what we get back in our savings, which gives them their profit. Some banks will also, though, charge for their services. So some banks do charge to access bank accounts, for example, pay things into your bank. So that can also give them a profit. What is probably worth pointing out at this point as well, though, is the difference between banks and building societies. Now, a bank and a building society, these days, they're becoming increasingly same as each other. Now, the main difference is a building society used to only do one thing with your savings. They would deposit, they would access your savings and use these to provide mortgage for people. So building societies used to literally be just for providing the finances for mortgages. And banks, well, these are the ones that have got this much sort of broader range of different services. So building society is just it's money provided through savings to people to take out loans and mortgages. Banks, they offer all these other different services as well. But increasingly over the years, building societies do tend to offer a lot of these different services as well. Another different type of financial institution is a commercial bank. Now, commercial banks are different to retail banks. Retail banks focus on households. Commercial banks focus on businesses. They will provide a range of different services for businesses this time, for firms. Okay, so again, businesses will have bank accounts. They will want to take out credit, take overdrafts, for example. But what commercial banks will also do is to give their customers, their businesses, if you like, that use them, additional services. These could be the options to pay suppliers. Okay, so facilities where they can pay people that they buy finished and semi-finished goods from, raw materials, for example. It could also be used to take payments from customers. Okay, so many businesses will use commercial banks to be able to give their customers the means of paying for things online, for example. Credit card payments over the till, for example, will be done through commercial banks as well. They can even use these to pay their staff wages. commercial banks will have the facilities where they can pay all the different staff that work for that business through their bank accounts. And obviously what commercial banks do, they also offer businesses that secure place for cash. So if you wanted to stop there, then retail banks would be for households, commercial banks are for businesses. So now the next one is what I would call an investment bank. Now investment banks, well, they do what they say on the tin. They invest money. So they will take our money, take businesses' money, and they look to reinvest it to give people a return, some kind of profit. Now what they will do is by taking people's money and investing it in foreign exchange markets, so hoping to get people profits on currency movements, for example. They might buy and sell commodities. Okay, so buy a particular commodity at a low price, hoping the price will increase, which will give them some kind of profit. They will also invest in bonds. Okay, governments issue bonds to raise money to cover shortages in tax money coming in. Businesses can also raise bonds as well to raise the money for investment. So again, investing in these could lead to nice returns for people. Other things will be what we call derivatives. So all a derivative is where the value of something is determined from something else. And what we're mainly looking at here is dabbling in futures markets. Okay, so where people might buy a future where they're given the chance to buy something at a particular price in the future. Well, what you might want to do is to secure a low price now, hoping it's going to go up, and then you can hopefully sell it for a bit of profit, for example. What you could also do with this one as well, investment banks, they also help businesses in terms of mergers and takeovers. Okay, so when two businesses start to join forces, for example, an investment bank will provide the services for that to happen. Takeovers will be where one business takes ownership over another business. Again, investment banks can help with this kind of thing. Now, the next different type of financial institution is something we call a savings vehicles. In other words, just different firms that provide people that chance to invest their savings wisely, shall we say. So, for many people, it's about their pensions. Okay, many people invest in private pension schemes to generate some kind of return in the future. This will probably be invested in lots of different things like stocks and shares over the time to generate a return. Linked to this one, we have annuities where people basically can cash in a part of their pension for a lump sum. You've got assurance companies, and what these guys do, they look at long-term investments for people, normally where your money might be locked in for say 10, 25 years or so. So looking here, it's sort of very much long-term savings. You also have private equity firms that will invest people's money in things like stocks and shares again. You've got hedge funds where people invest in lots and lots of different things, hoping it will reduce the risk a little bit. But linked to this, you've got again people investing savings into commodities and currency and stocks and shares. Another different type of financial institution, I'm going to keep it on this slide, is speculative. Okay, now a lot of these things are quite speculative in nature. Investment banks, for example, are quite speculative. All speculative means is that you've got lots of different financial firms that will invest people's money in a gambling kind of way, buying things at low prices, hoping the price will start to increase over time. And then the last one is insurance firms as well. And also what insurance firms will do, they cover people against risk by charging people premiums. Okay, so when you think about it overall then, we have 5 different main types of financial institutions. We have retail banks, which are aimed at households. Those are your typical high street banks, for example, that many of us will get our mortgage from. You have commercial banks, which are aimed at businesses. You then have investment banks, which are looking at investing people's money in long-term ways to generate more money. We've got savings vehicles, so this is sort of linked to people's pensions, for example. And then we've got speculative ones, which are linked to insurance firms. And then we have, of course, insurance firms right at the end. Okay, so there you go, the different types of financial